Good afternoon. This is the Asymmetric Daily Brief for Friday, August the 14th, 2026. This week, the S&P 500 closed at 7,799, an all-time high, and the first close in history above 7,800. 2 days later, the University of Michigan's preliminary Consumer Sentiment Index came in at 51. 51 is not a soft reading. It is the kind of number you normally only see in the middle of a recession. And on the same morning, retail sales fell 0.6%, the worst month since May of 2025, when the street had penciled in a small gain. So the market and the people inside the economy are telling two different stories this week. That gap is the brief. Let's walk it. The board, the S&P 500 closed at 7,798.99, a record, and the first close ever above 7,800. The Nasdaq Composite finished at 26,803, the Dow at 53,840. On Friday, both the S&P and the Dow gave a little back, but both indexes were still tracking a weekly gain. In rates, the 10-year Treasury eased to about 4.66%, but the 30-year auction cleared at 5.216%, the highest yield at that maturity since 2001. Consumer sentiment printed 51 against 54.5 expected. Gold sits near $4,373 an ounce, down about $28 from Thursday, and as always we quote the level and the dollar driver. Never a contested percentage. Brent crude is at $88.64, West Texas Intermediate at $82.89, both up around 4% on the week. And Bitcoin is near 62,800, trading below every major daily moving average. The board is arguing with itself today, and that argument is the story. Start with the consumer, because that is where the regime is genuinely changing. Retail sales in July fell 0.6% from June. The street expected a gain of 0.1. That is the steepest monthly drop since May of 2025. Underneath the headline, online sales fell 2.2%, the largest decline of any category. Car dealerships fell 2%. Gasoline stations fell 0.9. Total seasonally adjusted sales came in at $763.6 billion, down from a revised $768.1 billion in June. Now, in fairness, the cause is honest and unglamorous. Americans got government tax refunds in the spring, they spent them in April and May, and that boost has now faded. And sales are still up 5% against July of last year. So this is a deceleration, not a collapse. But the direction matters, and what came out alongside it matters more. The University of Michigan's preliminary Consumer Sentiment Index for August came in at 51.0. Economists expected 54.5. July's final reading was 55.2, so sentiment fell 7.6% in a single month, and it is down 12.4% against a year ago. Look inside the survey, and it gets worse. The Index of Consumer Expectations, which measures how people feel about the future rather than the present, fell much harder than the Index of Current Conditions. Short-term expectations dropped 11%, long-term projections dropped 17%, and the decline ran across the entire political spectrum, with the sharpest month-over-month fall among Republicans, whose sentiment is now roughly 19% below where it sat just before the Iran conflict began. Expectations lead spending. They just fell off a table. Which brings us to the first of today's three contrarian reads. The consensus this week is straightforward. Consumer inflation came in soft, producer prices were completely flat in July against an expected 0.2% rise, and so the market cut the odds of a September rate increase from close to 50% down to about 40%. Cheaper money ahead. Records justified. Here is the problem with that. Ask why prices stopped rising. Retail sales down 0.6. Sentiment at 51. Prices stop rising when people stop buying. That is disinflation, but it is the variety that arrives with an earnings problem attached to it, not the variety that arrives because supply chains healed. And notice that one-year inflation expectations actually went up in this survey from 4.2% to 4.3%. So the Federal Reserve is being handed cooling prices, a cracking consumer, and rising inflation expectations all in the same week. That is the least comfortable combination it can receive. Read 2. The consensus says the bond market is calm because the 10-year eased to 4.66% after the inflation data, and the front end is calm. But look at the long end. This week, the Treasury sold $25 billion of 30-year bonds at a yield of 5.216%. That is the highest the United States has paid to borrow for 30 years since 2001, a quarter of a century. It is up from 5.06% at July's sale and up from 4.91% just before the current term began. And the demand metric slipped too. The bid-to-cover ratio came in at 2.392, down from 2.444 in July and below the recent average of 2.429. Fewer bidders, higher price. So why does that split matter? Because the 10-year and the 30-year are answering two completely different questions. The 10-year is largely a bet on what the Federal Reserve does over the next couple of years. It moves on inflation prints and rate expectations, and right now it says, reasonably, that the Fed is probably on hold. The 30-year is something else. It is a bet on whether investors want to fund this government for a generation. At a time of very large deficits and heavy issuance, it answers a solvency question, not a policy question. And this week, those two clocks stopped agreeing. The front end relaxed. The long end printed a 25-year high with weakening demand. Now put the equity record next to it. The stock market set an all-time high in the same week the government paid the most to borrow in 25 years. That is not a contradiction you explain away. It is a divergence with a resolution date. We hold that read with high conviction and deliberately make no call at all on the timing. Read 3, and this is the one almost nobody covered. The consensus says inflation is beaten and the energy shock has passed. But one input just hit an all-time high. The diesel crack spread topped $98 a barrel, a record, after a drone strike on Saudi Aramco's Jazan refinery, a facility that processes roughly 400,000 barrels of crude a day. Sustained attacks on Russian refining capacity have compounded it. Now, a crack spread is simply the margin between what a refinery pays for crude oil and what it can sell the refined fuel for. So a record crack spread is not the same thing as record oil. In fact, crude is well off its highs. Brent traded as high as about $105 back on July the 23rd, and it sits near 88 today, which tells you the tightness is not in oil at all. It is in refining capacity, and that capacity has been physically damaged. And here is why that distinction is the single most useful thing on the board today. Crude oil prices pass into inflation quickly and visibly. Everybody watches them, they show up at the pump within days, and the Federal Reserve models them closely. Distillate margins do not behave that way. Diesel is what moves freight, farm equipment, and construction machinery. So a record diesel margin is effectively a tax on the cost of moving physical things. And it passes into core goods prices slowly and invisibly with a lag of a quarter or two, which means the market is currently celebrating a soft inflation print while the input most likely to uncool it sits at an all-time high. Watch distillate, not crude. That is the tell of the week, and it is our medium to high conviction read. Following the money into gold and the dollar. Gold held above $4,400 an ounce for much of the week, before easing to roughly $4,373, giving back about $28 from Thursday's level. The driver is worth stating plainly, because gold coverage is usually sloppy about this. Softer inflation data reduced the expected path of the policy rate. That moved the dollar and real rate expectations, and gold followed. That is the mechanism. Gold is still carrying a double-digit gain on the month. And to be explicit, we quote gold as a level with a dollar driver, and we do not quote contested year-to-date or trailing percentage figures because those get misreported constantly, and we have been burned by exactly that before. Crypto next, where the tape and the calendar are pointing in opposite directions. Bitcoin traded around $62,800, below every major daily moving average, with the fear and greed index sitting at 29, squarely in fear territory, so the price is soft. But the policy calendar is the loudest it has been all year. The White House will host cryptocurrency executives and separately prediction market executives on Wednesday, August the 19th. That meeting lands exactly one day before the Commodity Futures Trading Commission convenes its new Innovation Advisory Committee, and the Clarity Act, the industry's top legislative priority, is currently pending in the Senate. Worth noting for accuracy, the agenda and the guest list are not finalized, and it is not yet clear whether the president himself attends. prediction market traders responded immediately. The odds of the Clarity Act becoming law this year moved to 21% on Thursday, up from 17% the day before. Artificial intelligence capital. OpenAI's annualized revenue run rate crossed $40 billion, roughly double where it stood at the end of 2025, with the company's president saying revenue grew more than 20% month-over-month in July, driven by ChatGPT demand, its coding agent, and enterprise products. Both OpenAI and Anthropic have filed confidentially to go public, with Anthropic expected to list as soon as this fall. That would be the first genuine public market price on a frontier artificial intelligence laboratory, and SpaceX has finalized the regulatory procedures on its $60 billion acquisition of Cursor, an agreement that was signed back in June. Here is the connective tissue, and it is the reason this belongs in the same brief as the bond auction. The capital funding this build is increasingly borrowed rather than paid for out of internal cash flow. That quietly converts an equity risk story into a credit risk story, and it ties the entire artificial intelligence trade directly to the same long-end yields we discussed in Read 2. These are one story, not two. Sectors in play, 3 of them today. Refiners are the only sector on the board where the fundamental input is at an all-time high, and record distillate margins are an immediate cash-generating earnings event. The risk is obvious. Those margins depend on ongoing attacks on refining capacity, which is the least forecastable variable on Earth. Consumer discretionary is the mirror image. Retail sales down 0.6, online down 2.2, autos down 2. And sentiment at 51, with long-term expectations down 17%. The burden of proof has flipped. That sector now has to prove the consumer is fine, rather than being assumed fine. And then artificial intelligence and semiconductors, where the numbers on your screen are the story. On the Cursor bench coding benchmark, Grok 4.6 scored 70.8%. Claude Fable 5 Max scored 70.5, 0.3 of a point apart. But the cost per task was $2.81 against $17.32, roughly 1/6. To be fair, Grok trails on other benchmarks, notably Deep SWE and Frontier Code, but the direction is unmistakable. The competitive question in artificial intelligence has moved from the model layer to the cost layer. Now the sentiment beat, drawn from our market and social sentiment monitoring. The positioning split right now is unusually clean and unusually two-sided. The dominant strand of commentary is celebratory, and it is anchored almost entirely on the record index level and the soft inflation prints. That is the loud half. The quieter half, concentrated among people who watch the bond market for a living, is focused on the 30-year auction and the falling bid to cover, and it is genuinely alarmed. There is also a real analyst split on the Federal Reserve that is worth flagging rather than averaging out. The tape says cooling, therefore no rate increase, but there is a credible strand arguing the odds of a September increase could keep rising into the meeting, which would be a volatility event. Both can be true at once if you separate demand from cost. Demand is collapsing, that is the retail sales number. Cost is rising. That is the record diesel crack. Weak demand plus rising costs is the stagflationary corner, and it is the one scenario that neither a record index nor a very calm volatility reading is priced for. On the radar, Reddit joins the S&P 500 on August the 18th, which gives us a clean read on how much passive index demand is still out there. The White House Crypto and Prediction Market meeting is Wednesday the 19th, and the Commodity Futures Trading Commission's Innovation Advisory Committee convenes on the 20th. That one-day sequencing is not an accident, and it is the thing to watch. The September Federal Reserve decision currently carries roughly 40% odds of a quarter-point increase, so it is a genuinely two-sided meeting. The Clarity Act is expected up in the Senate in September, and the Strait of Hormuz remains unresolved, with no Iran-Oman deal, which is the supply variable sitting underneath the distillate story. Now the scorecard, because we grade ourselves in public. 4 new falsifiable calls today. 1. The gap between the consumer and equities resolves toward the consumer. That is wrong if consumer sentiment recovers above 58 by the October preliminary reading, while the S&P holds above 7,800. 2. Distillate not crude is the inflation input that surprises. Wrong if the diesel crack falls below $75 by the end of September without crude collapsing with it. 3. The long end stays decoupled from the front end. Wrong if the next 30-year auction stops below 5% with a bid to cover above 2.45. And 4. The competitive question in artificial intelligence is now cost, not capability. Wrong if any laboratory opens a gap wider than 5 points on a major public composite benchmark before year-end. So here is the close. Records are not usually set on good news. They are set on cheap money and confident people. This week, the market set one while the government paid the most to borrow in 25 years, and while consumers reported the lowest confidence since well before the Iran conflict began. So which one is the anomaly? The record or the 51? We genuinely do not know. But we would point out that of those two numbers, only one of them is a survey. The other is a settlement price on a 25-year borrowing cost, and it is being paid in cash. What we are watching next: the diesel crack, the bid to cover on the next 30-year auction, and whether September's sentiment print confirms 51 or corrects it. This is research and education only. It is not financial advice. I'm Earl, the asymmetric signal, one contrarian read a day. Subscribe.